I'm little princess here because these hands are delicate flowers, okay? I like it. It's up 80 times. Wow. 4 total stores. That's the number one question I'm going to ask with any retail. Get in the zone, AutoZone. Wasn't that the commercial for AutoZone back in the day? So guys, AutoZone, we're looking at that company today. We'll pull it up in our software. Guys, check out the stock price. AutoZone stock price at $2,325. Look at this chart. I went to high school in 1995. Let's see what it was back in August of 95. August of 95, it was $27. It's up 80 times or more since August of 95. That's incredible. So, you know, guys, there are some concerns about AutoZone. I don't know why, but people, I think that, oh, we're going to more electric. I don't think electric vehicles are replacing every car out there. Maybe it'll happen a long time from now, but AutoZone hopefully will be able to modify the way they do business. Let's see, 70% of sales in the country. They have 7,000 stores in the US, 700 in Mexico. Wow. Oh, no, sorry. They have 7,000 stores total, 6,200 in the US, 700 in Mexico, and 72 in Brazil. So let's check it out. A couple of things to look at to start. The one thing I think that is lovely about AutoZone, 5-year return invested capital, 78%. 1-year return, 130%. I think this is a record for the most I've seen. You get a $44 billion market cap with $63 billion enterprise value. That difference there is essentially their net debt, all right? So their current PE is 18, 5 years, 23. Look at this gross margin, 52% gross margin. 52%, that means for every dollar they bring into the company, 52 cents can go to pay overhead and their income taxes. And their bottom line after taxes and overhead was 14.6 last year and 14% overall. Now, one of the things I want to do before we go further, I'm going to pull up the annual report because whenever it comes to retail, I want to look at 2 things. 1, how many stores are they opening or closing? And 2, what are their same store sales growth of the last few years? Why does that matter? Well, guys, it's easy to show growth by opening more stores. But what I want to see is, are the stores you're opening that you currently have open and have had open for a while, are they still growing? That's the number one question I'm going to ask with any retail. How much of the stores that have been open for over 12 months, that's called same store sales or comparable store sales, how much are they growing? So I pulled up their 10K from August of 2022. So I'm going to look up comparable store sales. Look at this, guys. All right. They provide a lot of data on this. So I love it. Oh boy, where did we go here? Go find it again. All right, 18, 19, 20, 21, 22. 1.8, 3, 7.4, 13.6, 8.4. So we're seeing comparable store sales all across the board. I like it. All right, I like it a lot. Now, let's see if we can find out how many stores they have. So I always go to open. Let's see open. They usually have a chart here. There we go. 18, 19, 20, 21, 22. And guys, if you've never looked at a 10K before, I encourage it. Or if you don't like it, I get it. It's a lot of work. Join our community and you'll see here in the middle of this video how to join the community because there are people who enjoy reading 10Ks. I hate doing it. Mo likes to read it more than I do. I like to skim mine. But either way, here is beginning, sold stores, new stores, closed stores, net, and how many relocated. Guys, they've only closed 4 stores in the last 5 fiscal years. Even Tim's looking over at me right now going, wow, 4 total stores. Holy cow. Now, the question is, are they overexpanding? I don't know. I really have no idea if they are. The question is, they're only in 3 countries right now, US, Mexico, Brazil. What's the potential for that? I have no idea. 6,000 stores in the US, though, that's 120 stores per state. I love AutoZone. You know, I like it. I like going in there, having my issue, and they help me solve it. That's it. I'm little princess here. I buy wipers and I go, can you guys put them on for me? And they come out there, they put the wipers on for me because these hands are delicate flowers, okay? So those are the 2 things I'm looking at that is very interesting to me. All right, let's go check out the 8 pillars on this company. Oh, look at this. Okay, so we have a 5-year PE of 23 and a 5-year free cash flow of 20. Now, when the ratio's lower, it's better, right? It's showing more cash flow than this, than earnings. I like that a lot. Everything else wow, they bought back 25% of their shares. Holy cow. Now, I'm not going to lie, guys. I don't know if that's the best idea or not. They don't pay a dividend, and the stock is selling for not screaming cheap. That's why I bring this up. Is it screaming cheap to buy back 25% of your shares? I don't know. But look at this. I like this too. Very reasonable debt. Only less than 5 times their free cash flow. Man, look at this 5-year return on invested capital. Jeez, oh, Pete. Let's actually go check out their income statement. And by the way, guys, as you can see from our software here, these are our pillars. You can go edit your own pillars and put your own pillars in here with our software. It's really wonderful. So let's go to the income statement. Look at this revenue growth. Wow, big jump between 2020 and 2021. I'm surprised it didn't fall back down. Okay, net income. Man, good stuff. Cash flow statement. Okay, growing free cash flow. Average of 2.2 billion. All right. Let's see what analyst estimates are saying from our software. Earnings per share. Wow, it's pretty good growth, actually. Low double digits, pretty much for the next 4 or 5 years. Revenue growth, not as much, understandable. Low single digits. I think it'll be higher. I mean, guys, your revenue growth should grow at least with inflation, right? Because you're selling products that go up with inflation. Your costs are going up with inflation. I always find it funny when analysts are doing low single digits for a business that's still growing. Interesting. So the next question is, what's this company worth? So before we do the stock analyzer tool to determine what price to pay, if this resonates with you, here's our short explanation on how to get the software. I created the software that you're seeing on the video and behind me because I needed software for myself. This is not something that was created for other people and I use some super exclusive, expensive software. This is the software I use. And even better, we have this community of thousands of people there. And the reason it's so helpful is it allows us to eliminate the emotional fear that makes people make the bad decision investing. The right investing is 20% about the numbers and 80 or 90% about your temperament and emotion. And that's why it's awesome to have this community. The tools help you on the numbers. The community helps you on how to view your investments and your money. So stop making those terrible decisions that all your idiot friends make when they follow companies just because they like the company. For a little over $1 a day, you can have this entire software package. It'll change your entire future of investing and your money. So sign up now, risk-free, everythingmoney.com. Check it out. All right, guys. So whenever we do stock analyzer tool, you can do 1 to 20 years. And I usually do 10, but lately I've been doing 20. The question is, do I want to own this company for 20 years? Well, with that kind of return on invested capital, even if it decreases slowly over time, that's still a very, very high rate of return. This is a very, very good thing. Look at Apple. Apple's return on invested capital is in the 30% range, like 35%. This is over double that. This is pretty solid. So I'm going to do a 20-year analysis. Now for revenue growth, I'm going to do 3, 4.5, and 6%. At 6% revenue growth, that's doubling essentially 1.5 times. So is that a lot? Well, maybe, but it also could be pretty reasonable. So I'm okay with that. Now, profit margin. Guys, look at this profit margin. It was 12.9 over the last 10 years, 14% over the last 5 years, and 14.6 last year. So I'm going to be a little conservative and call it 12, 13.5, and 15. Free cash flow, I'm going to do 13, 14.5, and 16. Because if you look at the free cash flow here, they actually have more free cash flow than earnings. That's pretty awesome. Now for our PE and price to free cash flow. So guys, the higher the return on invested capital, and the higher the growth rate, the more you should pay for the company. This company has a very, very high return on invested capital. Very high. So I'm willing to pay minimum the market average, which is 15. I'll go 15, 16, and 17. And I'll do the same thing for price of free cash flow. Remember, the better the company is in terms of how they manage their cash and their moat, a high return on invested capital is a good way to look at a moat. And AutoZone, I'm not going to say they are a moat, but boy, they have a good brand name when it comes to helping people with their cars. And 2, growth rate. Now, AutoZone has 7,000 stores worldwide. Even if they grew 70 stores in a year, that's only 1% growth from its standpoint of organically. Sorry, not organically, from actual growth from within the company. Now, one of the things I also want to learn about their growth rate is how much it costs them to open these stores. So if you really want to get more detail of it, like how much capital, what's their plan, and how much capital are they going to eat up, and what kind of return do they get on that capital? Now, finally, for my desired return, guys, you can get 9 or 10% from investing in an ETF. So to have a good margin of safety, and you go higher than that. I usually start at 12, but if I make really, really low assumptions, I'll sometimes put 10% in because I'm like, you know what? I'm okay making the market average on what I perceive to be a lower risk situation. But for here, I think there's uncertainties in the auto business, what's going to happen. So I'm going to go 12, I'm going to go 14, and I'm going to go 16% because I do believe that this 6% number is going to be very difficult to do. So I'm doing high numbers on everything here. I need to have a really ample margin of safety. And the more return I want, the lower the stock price. All right. I'm going to hit the analyze button. Now, 6 numbers are going to pop up. And those 6 numbers are going to be low, middle, and high in earnings, multiple, and low, middle, and high on free cash flow. If it's all green, it doesn't mean go out and buy. This is all the more reason why we talk about this community. People will go in there and say, hey, I've been looking at AutoZone. What are your thoughts on it? And people have a conversation about it. That's what's really important about all this. So, boom. It's currently on my watch list at $1,200. But look, I have a low price of $1,200 to $1,300, high price of $1,475 to $1,500, 1350 to 1450. My watch list price, I think, needs to be edited. I'm actually going to put it at 1350. I probably haven't done this in a while, and I'm adding it to my watch list and staying on it. And now the software, my phone app, and email will email me when the stock price hits that. And you might sit there and say, Paul, it's at 2,300. It's never going to fall to 1,300. Go look at our past videos when we said things had to fall, and people said that would never happen. And invariably, pretty much all of them have happened. Thanks very much. Take care.